Welcome back, ladies and gentlemen, to another Startup Junkies podcast. This one looks a little different because we've been in person. We've been after a period of virtual, and we're going virtual again. So thank you for tuning in to this episode. My name is Caleb. I'm joined by my co-host, Jeff. We are Startup Junkies. And we are excited to be joined today by Hall Martin. Hall Martin is the founder and CEO of 10 Capital Group. He launched the firm as Texas Entrepreneur Networks in 2009. And today, 10 Capital has over 12,000 investors in its network and has helped startups raise over $900 million, that's no chump change. Hall, thank you for joining us.
Well, thank you for having me. Looking forward to it.
So Hall, give us a little bit more of the origin story. You know, I'm angel investor, serial entrepreneur as well, but there's always a story. Sometimes it includes bourbon and bad habits. So we want to hear your story. How'd you get to the point of doing what you're doing today and having such a big impact?
Sure. So after graduation, I actually worked for a company that I was there for 24 years in the high-tech industry, if you can imagine that. But it was a great ride. I was employee number 93, and that went up to be a $1.5 billion company. And they went IPO in 95, and so I started doing angel investing after that. And we had a local group here in Austin called the Capital Network that ran from 95 to about 2002, and went in and started doing angel investing. And back then, people would stand up and they would ask for $5 million to start a web business. And most people today don't believe me, but back then you had to pay American wages for everything, build your own server farms. It was just expensive to do, but it was a lot of fun as well. Made one investment and pretty much lost all my money and started realizing, well, this is harder than it really looks. And so after about 2002, when that group went away, we didn't have an angel network in Austin for about 4 years. And then the city did a restart and they called it the Central Texas Angel Network. It was now a membership model. It was one of the newer dinner club model formats that was coming out. And so I was the first member to sign up for it. And, in angel groups, if you're the first member in, you're automatically on the board in charge of membership. It's a great honor. There's no pay, but it's a great honor to go do this thing. And so I had a lot of fun with this. I'd been working for the company for many years, and when it was a small company and innovative and startup, it was a lot of fun. As it got bigger, every meeting was a budget or forecast or something that wasn't quite so innovative. And so I started losing a little bit of interest at that time and started having a lot of fun with this angel thing. And so after about 3 months as being the board and recruiting investors and so forth for the group, we lost our director. So I became the director. I stepped into that role and went on to recruit about 50 members. And over the next 2 years, we invested about $5 million in about 20 deals. And like I say, just had a great time putting that program together. And, that $5 million later turned into a combined 35x return for the investors. We had 2 home runs that went all the way with it. And then we had several winners. The rest of them were the usual 1x, 2x, and then we had our set of failures as well. But it was a lot of fun, and that propelled the group onward. And then my undergraduate alma mater, Baylor University, came to me and said, well, we want an angel network out of the Alumni Association. And I thought, that's a really great way to do it. We ought to tie it to a university. And so I went and helped them put that together. And it was all about student education and student experience and job placement. And the angels that came together, that was their why. And that's where I really learned that in angel groups is if the why is just to make money, you're going to have a 30% turnover rate every 12 to 18 months because people come in, invest their current allocation, and then they're going to go wait out to see how it works out, which is a 5 to 7 year wait in most cases. But with the Baylor group, it was about helping the students because they were brought in to help do the analysis and diligence and other things for the investors. And they got great jobs afterwards because they would do 20, 25 hours of work on those things. And so we had a lot of fun with that as well. I'm still a member of that group. We just passed been in business now for 13 years. I believe we've been going with that program as well. And then I had a local group near Austin, Williamson County, just north of Austin, one an angel network. So I put together a program from them that was mostly retirees that wanted to come out and do deal flow. And we did that for several years at the Terra Vista Golf Ranch. So I had a lot of fun doing these angel groups. And in about 2009 to 2010, I said, well, I'm ready for my second career. So I retired from my day job and I started a company called Texas Entrepreneurs Network. And we were helping startups solve that problem. I saw that entrepreneurs had in raising funding. Because what I witnessed when I ran those angel groups is that entrepreneurs would come in, pitch to my room full of investors, didn't see any checkbooks come out, so they walked away, and we would never hear from them again. No idea what happened to them. They just disappeared on us, and they got little or no money. 10% though came back, gave us updates, reminders, told us more about it. And on the fourth update, out came the checkbooks. You have to build a relationship and demonstrate the growth story. And that's more than just one pitch. That's going to be over a period of time. And so that's what I built Texas Entrepreneurs around. Was we were going to be basically doing the investor relations piece to help the startups get their documents ready, help them pitch, and then, and most importantly, help them follow up. Go back and show those investors that you're actually making progress. Oh, by the way, to get funding, you do have to have progress. That was another thing we had to teach people as well. So we ran this program under the name Texas Entrepreneurs Network, and we did funding forums all over Texas. I had the model that for every 10,000 people in a city, there was one angel investor. So I took the group out to Lubbock. There was about 100,000 people at the time. There were 10 angel investors, and out to El Paso and all the way around Texas. And so we had that model going where we're taking angel groups out further from the core cities of Austin, Dallas, and Houston. And so we had a lot of fun with that. And then along about 2017, we started getting calls from outside of Texas saying, well, I'm not in Texas, but I want access to your investors. How do we do this? And so we changed the name to 10 Capital and started working around the US instead of just around Texas. So that's how we got to where we are today and why it's now called 10 Capital. And that's what 10 stands for.
That's very interesting. And I mean, it's obviously an accumulation of a lot of lessons learned. You've been on all sides of the table, both as a operator in a company that scaled and went public, and then as an investor. What, you know, our audience is a mixed bag of people, business people, investors, startups. What are some of the key tips that you'd say for if an entrepreneur wants to go this venture scale route and they're looking to approach an angel fund? What kind of stuff should they be prepared for in your judgment?
Sure. So number one is you need to get your investor documents ready. I'm amazed how many people are out pitching and they really haven't finished the deck and they really haven't put the financial projections together. And I always coach them, let's get the basics together so we look like we're put together when we get to the investor. Even the data room, put together a drive with, you know, the core documents that people would expect to see, get a 5-year financial projections up there, you know, as best you can, and then have your story together in a pitch deck and be a little bit more organized about it. The next thing is I always say you never want to talk to an investor without bringing up a customer indicator, a customer validation. We talk to a customer and they like what we're doing. We talk to a customer and they're thinking about signing us up for a pilot. We talk to a customer and they are giving us their care-abouts and so forth. And most entrepreneurs come in, they want to talk to you about the product. Products in alpha, it's in beta and so forth. And that's part of it too. But what the investor's really worried about is, are you connected to the marketplace? Are you getting any market reality? And so you should really put that first and foremost in your pitch. And number 3 is you should have a growth story. After the first pitch, what the investors are going to look for is a growth. Things are moving forward. There's momentum and traction in 4 areas: sales, team, product, and fundraise. The things you're doing, you know, how big the market is and what the competitors are doing really don't matter anymore. It's really what you are doing. And you want to demonstrate that you are actually making progress going forward. And the final one is the rule of pitching is if you don't mention it, it doesn't exist. So if you forget to tell them about your revenue, you don't have revenue in the eyes of the investor. So some of the things I tell startups when they go out to raise funding is we need to be, you know, ready for the investors to actually close them.
Yeah, you know, the choreography of having a pitch together and having all the basics is really important. Being smooth during the pitch. How do you coach them around the Q&A? Because I can tell you from my own experience, and my portfolio is probably 90 investments, and I've run several small funds, investments either direct or through the funds. But the thing that I always find is that they're not really always ready for the Q&A. What kind of advice do you give them for that part of it?
Sure. So there's a couple of things to do. Is number one, go through your business plan and identify the risks. You know, put your investor hat on, and as investor, what risks do you think you may see in the deal? and then come up with a message about how you mitigate that risk. And a risk may be, well, how do you know the team's going to work together? And the answer is, well, we've been working together for the last year on these other projects and we've been doing fine. Something like that, where you have some reason to show that you've already proven that point, or you've got something that mitigates that aspect of the deal itself. And then two, you want to make sure that you have good, short, clear answers for questions. I find the most common thing I find among entrepreneurs is they want to tell a story on everything. And, the story has its place, and sometimes the investor will ask for the backstory, but if they're not asking for the backstory, just tell the answer in, 10 words or less directly. What is the answer to that question? Because sometimes they have 20 questions and they only have 10 minutes. Well, we're not going to have time for 20 stories. We're only going to have time for 20 answers. So we want to respect their time and make sure we answer in the right way.
Yeah, you get to the point, and it's kind of like, in cycling, they call a time trial the race of truth, because you can't hide behind the peloton. I find that Q&A is kind of the race of truth for an investment decision, because that's where it's you against the question. Your ability to succinctly respond is so important. So, I think that's really sage advice. Caleb, over to you. I know you've got a few.
Yeah. So Hall, I was looking at the website for Teen Capital and was reading about, it being a funding as a service platform. So I wanted to see if you could kind of highlight what funding as a service is exactly.
So we took a little bit of a different approach. One of the challenges I saw in the funding world, especially if you raise a fund, is that you're in this constant cycle of raise a fund, deploy it, raise another fund, deploy it. And as long as you're getting good returns, that works. If you get a bad return, it can stop working on you. And so I wanted to get out of that model. And so we decided to take a step back and look at the process and treat it more as a service project. What can we do to solve the hard parts? And with startups, we found that the hard part was getting the introduction and telling the story or keeping the relationship going. It's just so easy to get caught up in doing other things, and you can spend a lot of time trying to get that warm introduction to an angel group. So we were solving that problem for them. And then we found that we had a lot of micro VC funds coming in wanting to raise funding, and they too needed introductions to limited partners, family offices mostly, that would put money into early stage venture funds. And we were applying our process there. And then we found angel groups, they needed members. And so we found we could actually go out and help them recruit members for their group through our network. And that was a service that we could offer them. And we then put it on a retainer model, which is pretty close to recurring revenue. It's not exactly the same, but it's pretty close to it, where you're getting a stream of revenue every month from those who are using those services. And now we're moving into syndication platforms where startups are coming in, especially from the crowdfunding world, saying, hey, I really liked having my deal up on a portal. Where can I put it now? And I don't want to be captive to just one portal. I want anybody to use it. And so that's what we do. We have a syndication platform where we can put it up there, charge a monthly fee, but it's now reasonably priced, and you can get investor relations services at a much more startup friendly price than ever before. Investor relations have been around for a long time in the funding world, but usually it's for later stage companies, those that are public and whatever, and they charge $25,000 a month or whatever that is. And of course, we're being very friendly to the startup world because we work with seed, Series A, and Series B startups for the most part.
That's very interesting. I mean, and the thing that a lot of people don't realize, they tend to put themselves in the entrepreneur's mindset. Raising money sucks, regardless of whether you're the entrepreneur or a fund manager. So it's important to have support from multiple different angles to help kind of round off some of those rough edges and make it a little easier. I think that's really insightful. What do you see coming next in the funding world? We've seen the rise of some of the equity-based crowdfunding platforms. You've got the funding as a service. Do you see deal structures changing? We've seen that over the course of the last 10 or 15 years, the evolution of convertible notes and safes and even some revenue-based investments. What are you seeing? What's your crystal ball look like?
Right. So my fundamental thesis is everything is going online. I mean, everything is going online. And dinner club model angel groups are going to have to start finding an online path for finding deal flow, finding investors. And you saw that through the pandemic, where everybody was on Zoom. Afterwards, everybody's now in a hybrid model where they're doing both. And at heart, people want to remain true to their local roots, but at the same time, they can now recruit investors from anywhere in the country, and they can recruit deals from anywhere in the country. And you start to ask yourself the question, do I want the best local fintech deal, or do I want the best fintech deal anywhere? And the answer is the latter. I want the best fintech deal anywhere. And Zoom and these other tools give us access into that. So I think everybody's going to go online. And so I see people, and I see everything as a crowd. You know, the crowdfunders is a unique crowd. You need to have a consumer-facing deal, has to get people inspired. They have to get it when they just look at it on the screen. And then angels will still be angels, go to market. They add value in the way of team and network and other things that go into it. And then venture capital can give you even more management expertise and scale up. And so I find people coming to me now are really going from one group to the next. And what we end up doing is what we call repositioning, taking the same deal, but just making it more applicable to that group. What is that group looking for, and promoting that as well. And so I think going forward, you're going to see just many, many more funding sources coming up. There's now over 4,000 micro VCs out there, many of them very, very specific in what they do. And so it's just a matter of knowing where the funding is. It's out there. And that's a lot of what we do, is we can show them, here's where the funding is and here's what they're looking for. Maybe a little different from the last group you went to. And so you want to adjust your presentation accordingly to make sure you're matching or hitting on the careabouts that this group has as well. And we're seeing more alternative investment structures, like income share agreements are starting to come up in the funding world. We've seen several of those where that came out of the educational industry, where people would invest in their tuition and then they would get a share of their income afterwards. Well, now we're seeing the same thing, because it helps align the investor with the startup, because in the end, the thing that the startup really cares about in the short term is how much salary can we take home. And so investors can get right in there with you and be a part of that calculation for sure, and help drive that number up as well. And then we're going to see some other structures coming out, primarily with the blockchain and getting into tokens, and those kind of models bring a different set of things. And the third thing I think we're going to see is impact investing. I used to think about a quarter of our deals had an impact or ESG, environmental, social, or governance care about. I see that going up every year, just naturally. It's now 40, 50%. I'd say half of them are impact deals at some level. And my prediction is in 3 to 5 years, all companies will be impact deals at some level. And I see the financial community moving to a mode where they're going to start to apply financial returns to your impact. If you meet your impact, okay, we'll lower your interest rate by 2%. You don't meet your impact metrics, we're going to raise your interest rate by 2%. And there's a big move now to try to standardize what those metrics are, so it can be standardized, portable, transparent, across the board, consistent. But I think that's where it's going to go. We see a big shift from nonprofits to impact deals. And then we see big companies, BlackRock and others, starting to really put a lot of focus behind this, where, a company, you have to do more than just make money. You're going to have to do some good. And the challenge for the startup there is you have to measure what you're doing. You have to have some impact metric in your business. And we spend a fair amount of time with startups helping you figure that out too.
No, it's quite interesting. And it has to be more than sort of a marketing veneer. I think that it's got to be integral to the culture and the mission of what they're doing, the impact piece of it, or else I know there have been times when people have come to me and it's like, when here's the old business model, and oh, by the way, we give 10% to X, and they try to claim that, it's an impact play or it's a social venture. And it's like, not so fast. I mean, if it's not integral to the culture of what they're trying to do, it can be viewed kind of as a veneer. But I think you're right. We're seeing a lot of conversation around ESG and impact and social good. And I think that the entrepreneurs that we see that really get it are the ones that realize it still has to eventually be a very profitable business, because philanthropy is not going to carry the day. And they have to show the other bottom line with the impact. So I think that's a great insight. We're starting to see the rise of much more interest in impact-based deals locally, and a lot of stuff happening in local university at the University of Arkansas around that as well, because people realize that this is just the direction. This is a mega trend, the way the world is going, and it really makes sense for sure.
You definitely see it when, to your point, Jeff, in working with, university students that come through any of the programs or events there. I mean, everybody's has an impact or some sort of philanthropic goal associated with their venture that they're pursuing. With that in mind, and kind of, as far as what's coming in the future, what advice would you give folks in flyover country as far as what the recipe might be for building their own successful angel network, and like I said, the heartland or flyover country, and what's the recipe? What are the pillars that need to be there?
I think the key is to, number one, find what your why is. Why would we come together? What is our mission? What we're going to do? Because I've seen groups that we want to make money as their number one care about, and that can be tough to really grow and sustain. I've had other groups talk about how we're going to educate students, and that's much more impactful and much more. Groups stay together much longer for that why. So get your why down very clearly, and you can start with a local need, whatever the local impact might be, and build around that, and then start to replicate that across the country as well, and set it up to be something that you can actually grow, because now angel groups can have members from anywhere in the U.S., and we're probably 3 years away from true internationalization. I get calls every day from Africa, Middle East, UK, mainland Europe, Southeast Asia, and other parts of the world. And I've actually sat on panels for accelerators in Western Romania. I was on one the other day in Jordan and other places. And it's just like this. Everybody's speaking English. The deals are all using the same AI, blockchain, some technology that we're all familiar with, and we're all looking at the application, and they're using a safe note, convertible note. The ownership rules are starting to align a little bit. In the U.S., you have to have a Delaware C, but what they have overseas can vary from country to country, and I see those aligning. So I think very soon we'll start to be seeing that you can scale not only across the U.S., but in 3 or 4 years, you'll be able to scale across the world. So think about your why and start with that first, and build a group around that, and then grow up the model from there. And then second, based on what you're funding, choose the right model or the right investment structure. In many cases, people walk in wanting equity, and then when we talk to them about selling the business, well, this is really a family business. We're never selling it. Okay, well, now we're talking about revenue-based funding. Yeah. So understand the market and make sure you're getting the right deal structure, because equity may not be the right thing for everybody, of course. So those are some ideas to think about: is why, deal structure, and setting it up to scale across the world, not just across the U.S.
No, that's great advice. I mean, building those bridges is super important. And we've done some of that outreach and have strong bridges built to South Korea. And we look at those deals as potential investments, invite them into to pitch the local angel network. It requires people to get over the kind of paradigm or sort of the myopic view that, no, I'm really only interested in investing things that are around here. The approach we've taken is, let's pick an investment thesis around sectors where we can help move the needle with these companies. Let's not worry about where they come from. And I think that speaks to the point you're making, is matters a whole lot more of who you're with rather than where they are. And if you apply that kind of principle, you're going to see better deals. You're going to get more flow. And the other thing that's interesting is sometimes these angel groups come together and it's viewed a little bit as philanthropy or local economic development. We need to have it. And they say, we're only going to invest in deals in this geography. And when you do that, you really limit the opportunity, particularly in an emerging ecosystem, for the investors. It may be great for the entrepreneurs that are local, but this other constituency that you got to have is going to be disadvantaged. And we've seen that you get investor fatigue through that, because things get stretched out. You don't get the frequency of returns. So, I mean, a lot of what you're saying is really music to our ears. And you're, as with most things associated with Texas, you're about 15 years ahead of where we are, but we hope to kind of shoot from your shoulder, so to speak, and learn a few things. That's really great advice.
Great. Well, glad to help in whatever way I can. We do a lot of events to help startups come together. We have a fundraise launch program once a month. People come in, we get an hour, you get to ask any question that they want. We record it and put it on a podcast so everybody can listen to it afterwards, get the answer to that question. So it gets the word out to a broader number of people more quickly. We're also into content repurposing. You can transcribe that podcast into a blog post and put that out as well. We got about a dozen e-guides up there, and we got another 20 on schedule to come out. We have what we call the Startup Funding Espresso. It's a 2-minute podcast every day that comes out Monday through Friday. You can read or listen to it. Done over 500 of them. And you can, if you want to learn about startup funding, you can just subscribe to that and get a short soundbite every day. In the time it takes to drink an espresso, you can learn something about startup funding and investing. And there's a lot of great tools out there that you can really use to learn about it as well. But I think it's going to go international here very shortly. And it's going to be, when people realize the reason people wanted to invest locally was they wanted to get there and back in under 2 hours. And
right.
Now with Zoom, you can certainly do that with just about anywhere. And so now it's going to be, that's a real game changer that people can now, they're not limited anymore. And then you're always looking for better deals, and it's going to come to you very quickly. I'm going to have to look further afield for it as well.
I'm going to ask you a bit of an inside baseball, kind of a wonky tools question. So we've seen the rise of things like Carta, which a lot of companies are using just to manage your cap table and to be able to do investor communications and whatnot. Do you have any favorites in that space? Or are you seeing stuff that you really like that makes it easy once you've got a large portfolio of investments to keep track of how the company's doing, and it simplifies it from a reporting standpoint for them? What are your thoughts about that emerging space of just investor visibility and reporting?
Sure. So when I think about, the actual cap table, what my experience is you want people that are experts at that thing. Carter's expert at, cap tables, but now they get into 409A and they get into doing syndicates and SPVs, and they're really not the experts there anymore. So you want to stay with the experts. You don't want to go with the one-stop shop, because there's really not much of an advantage to that right now. We have a regular monthly clubhouse room where we invite angel groups out and we talk about tools. And about a month ago, we went around the room and asked, what tools are you using for your deal flow and for your cap table and for your SPV? And we came up with about 40 different software tools being used out there for it. And it was quite the range of what people did for it. So I think those are really great market opportunities for startups to actually go in and do some work, do some analysis on it, and figure out what the pain point is and come up with a best-in-class tool for that. Because in most cases, what you'll find is they're okay tools. We can kind of make it work, or it was already there when I got there, or it's good enough, or what have you. But I think there's going to be a real demand for best in class for deal flow, for cap table, for portfolio management, for data rooms and other things. And I think the opportunity is just right there. Angel groups in the past were so very fragmented, but what we're seeing now is I have 200 on my list, and they're all pretty much facing the same thing. You came up with a great tool. They would be very interested in being a part of it. You do have to get appropriate with the pricing model. Angel groups are not going to pay the full freight. There's going to be other people in the system that should be helping pay that cost. So the business model's got to take that into account as well.
I got you. That's great. And one other is, and again, it's data point of one. It's just where we are. 2007, 2008, when the public markets were kind of in the tank and real estate was totally blown up, we saw lots and lots of interest in doing angel investment. People were like, yeah, this is an asset class we should probably look at. When those two things go the other way, and when you've got all the crypto stuff going out of sight where people are taking $1 and it's $500, a few weeks later, even though it's very volatile, it makes it difficult as an asset class sometimes to make the story for angel and early stage investing. When you confront that, you've obviously been very successful. what kind of conversation would you have with somebody that's high net worth, maybe made a bunch of money in a particular industry? They haven't done angel investing before. How does that conversation go for you when you're talking to that person about why they should jump in?
Well, there's really two worlds in the startup world today. There's the traditional world where the angels came from, where it's a good business and we're doing MVPs and we're bootstrapping it up and so forth. And then there's another world that's the unicorn world, where everything starts at $100 million and goes up from there in valuation. There's nothing less. And there are some technologies and groups that play in that unicorn world. And those are typically the big funds, the big marquee venture funds are playing in that space. And so you can choose that space or you can choose the traditional space. And so, especially in middle America, I'm kind of choosing the traditional space. We have unicorns in Austin and, they're everywhere now, but they're really not the mainstay. And, if your why is to help the community, then you're probably going to be choosing the traditional one. If you really want to be a part of a rocket ship, you can sign up for a unicorn and be a part of that. But typically the dollars are so outsized in that unicorn market that you really can't stay in there for very long before it just goes off into the billion dollar valuation land. And, it's a different space. So I think you have to go back to your why. Why do you want to invest? What do you want to accomplish with your investment? And focus on that. And in most cases, it's going to be in that traditional space as well. And I think like I say, I'm a big person about thinking about the why, because I saw that with the Baylor guys, how, their turnover rate, for a third of the group was every 7 years, not every 18 months. And so there's something to be said for that. People stayed because they were there for more than just the money. And that's my question to an angel investor. What would keep you there more than just the money?
That's great. Great advice. Caleb, about that time to land the plane, I think.
Yeah, Hall, one of the questions we ask our guests, as we land the plane, so to speak, is if you had the opportunity to go back in time, whether that's back to 2009 or beyond, and give yourself advice, what advice might you give yourself?
I think in the end, investing is not so much about the finance; it's about the relationships. It's about building relationships. I sometimes hear startups tell me, complaining they had to go talk to that investor again, and I say, no, you get to go talk to that investor again. You get to build a relationship, because relationships is what carries you all the way through. And the more you have of that, the more you build that, the better things go. And so think of it as this is a series of relationships, and rather than a series of financial transactions. If you look back on financial transactions, that's not so meaningful. But if you look back on the relationships you built, that's what you're going to remember in the long haul. And that usually goes toward the why as well. So I always want to make sure we're all focused on the right thing, which is investing is about people and really understanding who people are. If you ask any investor, what's the number one thing about the investment they made, is the team, and part of the team is the relationship you have with them. So that would be the lesson I would take out is, don't just treat it like a transaction, treat it like the relationship you want it to be.
That's fantastic. I mean, great advice, great insights. We appreciate you sharing your experience and your wisdom. And if the viewers and the listeners want to find out more about what you're doing at 10 Capital Group, what's the best way for them to find out more?
Best way is to log on to 10capital.group. That's our URL. That's our website. There's no .com on that. And if you want to listen to our podcast, it's investorconnect.org. Investorconnect.org is our podcast site, because it's got so much content on it. We had to make a separate site out of it. But a lot of great ways to learn about what we're doing here to educate the startup and educate the investor, and help everyone find their why.
Hall, thanks for coming on. It was really great talking to you.
Great. Well, thanks for having me. I enjoyed it.
You bet. Take care.